Hi, Dr. Scott here. Proceeding into Chapter 6, Internal Controls, Bank Reconciliations, and some of the concepts associated with protecting assets. So we're going to go ahead and share our screen and walk through some of the slides that talk about what we're doing. All right, so what are we doing with an internal control system? Think about a church. Passes around the plate. Monies are collected, and they go into a room, money gets counted and gets deposited into the church's account. Do they have just one person taking a look and counting the money? Well, hope not. Usually two or more. Does that mean there's a guarantee that there will be no fraud, that there will be nobody stealing? Two or three more people is called collusion when they lie together and say, let's half for the church and half the rest we split. May not be real ethical, may not be real nice, but it does get done. But our internal control systems, our best shot is to protect assets. And cash is the easiest asset to shoot at and to take. It's the most liquid of assets. We want to ensure reliable accounting, and our company policies want to be upheld. So we want to be able to understand that, yep, we're following the rules and regs of what the company wants, and we want efficient operations. So if we're looking at SOX, if you remember Sarbanes-Oxley, and that was out in 2002, came about as a result of Enron and WorldCom and some other heavy-duty frauds, to basically to restore trust in the economic system. So when we do that, what happens is we take a look and say, all right, we have to follow a whole bunch of rules in Sarbanes-Oxley. It requires managers to document and assess effectiveness of internal control processes. It also requires a CFO, a chief financial officer, and a CEO, the chief executive officer, to sign off and say, I take responsibility. Enron's CEO, Skilling, tried to put it off and said, I'm just the CEO, I don't know anything about accounting. Legally, he might have been able to get away with it, but not with SOX anymore. They require the sign off and to make it work. COSO, the Committee of Sponsoring Organizations, they talk about, part of SOX, talks about 5 things that regarding internal control. Control the environment, risk assessment, activities, control activities, information communication, and monitoring. This list of 5 won't be on your exams, but it is good background to understand what's involved in internal controls. So what are we trying to do here? On internal control, we're trying to establish who's responsible. That's why you don't have a cash register that when somebody changes shift, you don't say, hey, I'll take over your register and I'll take over your register. Oh, by the end of the day, you've got 3 or 4 people running the same register. If cash is over or short, most likely short, who do you blame? Who takes responsibility? So we need to establish responsibility. A couple of other internal control procedures and principles include maintaining adequate records. Yeah, I think I took in a whole bunch of money. No, you got to document more details. Ensure assets and bond key employees. Bonding is just an insurance policy. Anybody who's handling money, if you've got a cashier, you're going to bond them in case they steal. You have insurance to collect on that. Separate record keeping from custody of assets. So we're going to separate the environments and who's keeping the records and who's responsible for receiving the goods and using the goods. Divide responsibility for related transactions. And we'll see more of that as we talk about more of internal controls. Technological controls, we're going to have possibly cameras watching everybody do everything, doing counts. We're going to have computers monitoring and tracking. And then we have regular and independent reviews. A formal one is known as an audit. It's when outside accountants come in and review the books. It's not a guarantee they're correct. An auditor issues an opinion statement that says, in our opinion, the books are cool. Does that put a lot of assurance that they're right? Well, it's an extra set of eyeballs. It's an extra review by professionals outside the organization. And that adds some confidence, but it's no guarantee there's no fraud. There's no guarantee that there's something wrong or lying in the books. So why do people pay a whole bunch of money for it? Because it does add some assurance and it does detect some things and make sure people are maintaining the books in accordance with GAAP, generally accepted accounting principles. Internal control, first one was establish responsibilities. Tasks should be clearly established, should be assigned to one person, and then we can assess the blame if we need to, or the credit otherwise. So that's part of internal control. Maintain adequate records. Number 2, protect the assets. That's all we're doing. We're protecting the assets. We're not going to protect the liabilities. We're not going to protect the sales, although we want to make sure our sales are in sync. We're not protecting expenses. We're protecting assets, equipment, a computer that somebody doesn't walk off and take home, a car that someone doesn't drive away and sell and keep the money after selling it. Those are things that are assets that you want to protect. You want detailed record, use the chart of accounts, pre-printed forms, pre-numbered sales slips, and computerized point of sale things that automatically record. That's why you sometimes see, we'll give you free ice cream if you don't get a receipt, because cash is sometimes pocketed and not deposited. Bond key employees, assets should be insured against losses, and that cash is that biggest, easiest target. Employees handling a lot of cash and other assets should be bonded. And again, it's a purchase of an insurance policy against theft by that employee. By the way, it's interesting. Do you think that if a bank has an employee that's stealing, that they are going to get the cops involved, they're going to arrest them, they're going to throw them in jail? Chances are they will just fire them and leave it at that. Why? Because as soon as the bank gets a public record and it's in the newspapers that so XYZ Bank has an employee that was stealing, the confidence in that bank goes to nil. So what's going to happen? You're not going to do banking or business with them. It's cheaper for them to absorb $5, $10, $20, $50,000 than it is to make a big deal of it. So what does this employee do that has 3 years of experience in banking? They go to work for another bank. They check their criminal record, no crimes. So you got to be careful. Just be aware. Separate record keeping from custody of assets. So the person who controls or has access to the assets should not have access to the accounting records. So we got to be careful on who keeps and maintains. When checks come in the mail to the accounting department, it doesn't the CFO who takes the checks, makes the deposits, writes the checks. Ideally, you have the receptionist writing down the deposit slip, and then someone else taking the checks and deposits to the bank. You want to reduce the risk of theft or waste of an asset. Employees would need to collude or agree in secret to commit fraud, which does happen. You can't get around collusion. It's very difficult to, unless it's obvious. Internal control, divide responsibility. Responsibility for transaction should be divided between 2 or more individuals. Insurers work at one person X to check on the other, called separation of duties. So we got to separate what other people do. If you got somebody who never takes a vacation, 5 years, 10 years out, they could be stealing. Millions of dollars have been lost by employees that thought were trusted employees, but they were taking money and depositing it in their own accounts. Duties weren't separate enough. Technological controls. Well, cash registers are pretty good. They actually give receipts. Time clocks for tracking. And personal scanners limiting access to authorized individual. So we got key locks. I'll give you one trick is if you're an auditor, if you ever go into a company and you have a locked file cabinet, check the upper right drawer, sometimes in the center, but usually the upper right drawer, the cabinet file key is in the drawer, and now you can open your file cabinets and do whatever you want. It's like taping a password to your screen. Bad ideas, but commonly done. And then regular independent reviews, okay? So we're gonna help make sure the procedures are followed. Auditors, usually outside auditors, although you can have internal auditors too. They can't give you an opinion on the books, but they can actually track and they can do additional work that instead of the outside auditors charging $200 to $500 an hour, you have the inside auditors at $50 to $100 an hour cost that are actually doing the reviews and taking care of things. Auditors evaluate the efficiency and effectiveness of internal controls. That came out of SOX. Sarbanes-Oxley requires a review of internal controls that wasn't required before. And then there are limitations. There's human error, oops factor, careless, misjudgment, confusion. But then there's a human fraud, intentional fraud, white-collar crime. There's a fraud triangle, opportunity, financial pressure, rationalization. Let's say you've been working for a company for 10 years, 15 years. You think you deserve more. They're paying you $18 an hour. And $18 an hour, they're hiring a new person off the street, $15 an hour, and I've got 15 years experience. Financial pressure. I get kids in college. I really need to help get them do what they do because I can't afford, and I got bills to pay, and I got to eat and everything. And there's the opportunity. There isn't a good internal control system that would catch somebody stealing. Opportunity, financial pressure, rationalization. The three legs of the triangle. There's a cost-benefit principle of internal controls. The cost must not exceed the benefit you're going to get. You shouldn't spend $200,000 on a security system to track $10,000 in cash and keep controls on top of that. Effective systems of internal control protects cash and cash equivalent. Three basic guidelines. The handling of cash is separated from the record keeping. I talked about the deposit slip, handling the cash coming in or the checks coming in, separate from somebody making the deposit and recording it. Cash receipts promptly deposited, and cash disbursements are made by check, not by cash. Again, cash is too easy, too liquid, and you got to be careful. And the cash you see in my background, those are euros, the European currency of the European Union. But this is cash we're talking about. Easily disappears. Cash management, twofold purpose. Plan cash receipts to meet cash payments when due. Keep a minimum level of cash necessary to operate. You don't want to have too much cash. If you got $1 billion sitting in the bank, you might say, I got $1 billion. That's $10 million a year in interest at only 1%. Is that worth having all that excess cash? You probably don't want to have excess cash. Cash management, encourage collection receivables. Can we collect in 20 days instead of 30? Delay payment of liabilities. Your terms are net 30. Do I pay in 2 days or do I pay in 28 days? By the way, let me talk about that. When I was in business as a consultant, I had clients that I know I'd send out a bill and I would have in my mail 2 days later, it'd be paid. I had other customers that I sent a bill and guaranteed it'd be a week late past the due date. When I got a phone call at my desk as a consultant from both those clients, who do you think I called first? Yeah, I called the ones that were prompt payers and they cared enough to pay me quickly. I care enough to get back to them. Now, depending on the size of the client too, obviously a larger client, I'm going to take care of all my clients eventually, but the first call is going to be taking care of the person that's prompt in their payment. So pay your plumbers promptly. They say, give me pay 30 days, pay them in 2. Pay your utility bill the day before it's due. Keep only necessary assets. You don't want excess assets. You don't want things that you have to worry about breaking or taking care of. Plan your expenditures, phase it in, have a budget, and take your excess cash and invest it. Don't let it sit idle. Those are some of the cash management tools and techniques. Cash receipts by mail. 2 people are assigned the task of opening the mail. Cashier deposits the cash in the bank. The record keeper records the amounts in the records. So the person actually making the entries is not the same person making the bank deposit. And that's been a problem. It used to be when you had 100 employees in a company, you had 20 or 25 accountants that are maintaining the books manually. Now, a 100-person employee company, you can have 1 or maybe 2 accountants entering in QuickBooks, running in a software system. All that centralized responsibility can be dangerous. So you got to watch out. You have to be careful. Cash over and short. Again, more likely to be short. So what happens if you count the cash register and you say, well, I'm supposed to have $120 here, but I have $110.48. You're short, $9.52. All right. Some companies will take that out of your pay. Some companies will say, do it again, you're fired. Some companies will let it go, and some companies don't even count the receipts in the cash drawers. So you don't want to be that last company, but you want to have some policies to protect the cash. There's a petty cash that I'm not too worried about here as well, but an impressed petty cash fund where you have money set aside. Then there are banks. Deposit tickets, bank statements, electronic funds, checks, bank accounts. And the deposit slip. By the way, a commercial account, they charge you for every piece of paper you deposit. You bring in checks, 2 or 3 cents a check. Every line item on a deposit slip, deposits, withdrawals, anything other adjustments to the account. You charge a couple of pennies. That's how they make their money on a commercial account. Individual accounts, you get all free checking usually. And that's the best way to go. And then you have a check. You write a check. Who's the payee? Hillcrest Lighting. What's the dollar amount? What's the date? And then you write it out. And then you sign it. Optionally, you can put a memo on there. But that's what a complete check looks like. The top half is what you give to whoever you're writing the check to. And then there's a bank statement. And what's your cash balance on your balance sheet? Well, it's going to reflect the transactions you've done, the checks you've written, the cash you've received, and sales that have been collected, and that's your balance. But the bank is always going to have some extra things on there. They're going to say, well, you ordered some checks, or they're not going to have all the cleared checks yet. So you need to do a reconciliation to see what the bank thinks you have and what you think you have. So it starts with a balance per bank and a balance per books. You add into the bank deposits in transit. The bank hasn't recorded that deposit yet. It's going to take 48 hours. Subtract outstanding checks. The bank has no idea what checks are outstanding. And then add or subtract correction or bank errors. On the book side, and you internally, you add interest and unrecorded cash receipts. So the bank is telling you, we got some money in, but you don't have it, put it on your books. You subtract bank fees that they charged you and not sufficient funds checks. Actually, that's the way I used to remember Scandinavia: Norway, Sweden, Finland. That's my geography lesson for the day. NSF, not sufficient funds. So checks bounce. And so the fees associated with NSF checks bounce as well. And then add or subtract corrections to bank errors. So here's a visualization of starting with a cash balance per the bank from the statement. Add deposits, take out outstanding checks, adjust bank errors, adjusted cash balance. On the company side, you have a cash bank balance per books. You take collection interest, things you don't know about. So everything in the blue is the things that the bank doesn't know about that you do. Everything in the olive or green color is everything you know about, but the bank you don't know about, but the bank does. So when they collect money or give you interest, oh, I got to add that. They charge me a bank fee, oh, I got to subtract that. And there's errors or adjustments. Bottom line, your adjusted cash balance is going to be the same on the reconciliation. You're going to reach the same point. That's the rule, and that's what's going to end up showing on your balance sheet. Calculation of days sales uncollected. We talked receivables turnover, and you have your net sales, net credit fulfilled officially, divided by average accounts receivable. Here you invert that, and you multiply by 365. So how many days does it take to collect your sales of receivables? 25 days, 30 days, 32. Faster is usually better, but it can be too fast. Let's think about that. What happens when you have terms of net 30? And you've got a client that says, great, I'm a C-store, a convenience store, I'm a gas station. It takes me about 20 days to sell the candy you deliver to me. Terms of net 30, great. Deliver it. Within 20 days, I'll sell it. I'll have a couple of days extra to pay you off. Now you say, I want to collect things faster. My accountant says I need to get my cash flow better. So you change your terms of net 15, and that's your choice. Company can do that. But all of a sudden, the C-store says, wait a minute, it takes me 20 days to sell this stuff, and in 15 days, I'm not going to have all the money that I need to pay you because I haven't sold all your stuff. So what's going to happen? They're going to find another vendor. They may charge a little more, but they give them 30-day terms. You're going to lose sales. So you tighten up your collection process and change the policies that can adversely affect sales or favorably. Maybe you give more time. Would you buy more stuff? And potentially, if you could have more time to pay for it and more time to sell it, that's a great question to ask. Well, that gives you an idea of what we're trying to do and cover here in Chapter 6. I just wanted to give you a perspective. Hope this helps. Any questions? You know how to find me. Look forward to your continued participation and appreciate your time and effort. You have a great day, and we'll look forward to seeing you again on the flip side.